Okay, let's go to the quiz at chapter 4, page 33, and we'll go over the quiz. It's page 33 in your chapter 4. All the books, I know it's hard to keep track. Okay. Alimony is taxable to the recipient. It's included on the tax return on Form 1040 on what line? B11, right. Where it says alimony received. Okay, what type of payment listed below is considered alimony?
C.
C, money. Cash, checks, or money order. And this is probably a good reference for everyone. Any of you, anyone you know, anyone you talk to. If you know of somebody that's paying or receiving alimony, suggest to them that it's really a good idea to always keep receipts. If somebody pays them in cash, make them sign a receipt. If you're paying somebody alimony in cash, maybe it's a good idea to use a money order, do a receipt, just to make sure that you have yourself covered. Because when the IRS says we want proof, you've got to have proof one way or the other, just to cover yourself. Just a good practice to get into. Always, always having a receipt. Paper trail is always a good thing when it comes to the IRS. So it says money, cash, checks, or money order, always really a good for either the payer or the receiver to make sure you have receipts. Okay, unemployment compensation is reported to the taxpayer on which form? 1099-G, right. Unemployment, 1099-G. If a taxpayer received an overpayment of unemployment during 2015, the amount of the overpayment needs to be listed on the 1040 on what line? 919, right. Ordinary dividends are C, taxed as ordinary income, right. Okay. What statement is true concerning the interest income from treasury bills? D, right. They're taxable to the federal, but not to New York State. What type of income is reported to the taxpayer on a W-2G? Gambling winnings, right. Are gambling winnings always on a W-2G? No. You go to the casino, they're going to give you a little tiny receipt, a yellow piece of paper that's going to come out of their machine. They won't send you a 1099 or a W-2G. The W-2G is basically going to come from a lottery, a prize winning, something like that. Somebody comes from the casino, all they're going to have is that little yellow receipt from the casino. So it won't always be on a W-2G, but some of them will. All right. Where on the tax return is income over $400 that's listed on a 1099 miscellaneous recorded? That we'll get into that when we do self-employment, but that is C, a Schedule C or a CEZ, that's self-employment income. All taxpayers must include their state refund on their tax return. Is that true or false? That's false, right. If they did not itemize last year, they do not have to put anything on there this year. What type of income is taxable to the taxpayer? C, unemployment, right. Form 1099-C, cancellation of debt, would be listed as income on the tax return on which line? 1040. Line 21, right. Is that always taxable? Cancellation of debts?
No.
No, it's not. If they are insolvent, it is not taxable. On that, do you remember what form that was? 982. If somebody's insolvent, we do a Form 982. And then their 1099 cancellation of debt would not be taxable. Okay. Any questions on any of those?
Somewhat not related, but if somebody has filed bankruptcy, that it always follows through and follows through and follows through. Is this how the government tracks that?
No, this would not have anything to do with that. This would be if you owed $10,000 on a credit card and you called them and said, there's no way I can possibly pay this. All I'm paying is interest. Will you settle the debt? And if they say yes, they may say, you owe $10,000. You send us a check for $3,000 today. We'll forgive that $7,000. And that's all well and good. They'll cancel your account. They'll take your $3,000, and in January you'll get a 1099-C for cancellation of debt for that $7,000. That's where those come from. Okay? So that's debt that's been forgiven, and you think that it's all gone behind you until that little 1099-C comes in the mail. Yeah. And then may or not be taxable to you. Okay, let's go to our book number 2 and go to chapter 17. Lori, did you bring both books or just one? I can take one. Okay, just a reminder, every week bring all 3 books, volume 1, volume 2, and your workbook, okay? Because we'll be back and forth through all of them. Okay, chapter 17 is, we're gonna talk about refundable credits. Now, some of the stuff we've already talked about. Because of the way we're going through this, we may be hitting some things that we've talked about before. There might be some things that we'll have to jump ahead, okay? But it will all fall into place within the weeks, and we'll review everything that we have touched or that's not clear, okay? It will become clear. Okay, this chapter completes a discussion on the tax credits, specifically refundable tax credits. As we discussed in chapter 13, or we will discuss on Thursday in chapter 13, there are 2 types of credits, non-refundable and refundable. Both reduce the tax due, but unlike the non-refundables, the refundable can be issued to the taxpayer as a refund. Hey, how are you? Good, how are you? Good. Yeah, my book. Did you talk to Maria and she was supposed to send it?
And I talked to, is it Liz? We talked to, I believe it was Maria, and we're gonna give it to you to give to me tonight.
They gave me anything.
Okay.
Sorry. I'll have it Thursday if you want to stop in Thursday. I'll make sure I have it.
Well, it's for the corporate plans tomorrow.
Oh, that.
Yeah, so.
Nobody gave it to me, sorry. Okay, so we've got refundable and non-refundable. So everybody remember what a tax liability is? Okay? Let's say your taxable income is $20,000. There's, just for number's sake, $500 tax on that. That is your tax liability, right?
Right.
Okay, so from that tax liability, if you have a credit that's not refundable, that could wipe away your tax liability. But if, say, you had a tax liability of $500 and you only had credits of $2, the refundable credit can actually come back to you, okay? A non-refundable will only reduce your tax liability. A refundable will go beyond that and actually go back in your pocket, Make sense?
Mhm.
Okay. So what we're going to talk about is the different kinds of refundable. The main one being earned income credit. Earned income credit, we really have to look very closely at. Earned income credit is the biggest source of fraud with the IRS, so we really have to be careful how we handle it. We have to make sure that we answer the questions, we ask the questions. We have to know who qualifies and who doesn't. When we're doing the tax return, there's also questions in the computer that will come up that we have to answer. It'll ask you the questions, and you have to ask the client that's sitting right in front of you. Can anyone else claim this child? And we'll go through all those things. But it's really important because certain people are eligible for the earned income credit, certain people are not. And if you mistakenly give someone earned income credit that isn't supposed to, about a year and a half from now, they'll get a letter and have to pay it back. It takes the IRS a while to catch up. So we just want to watch. But if you follow and you ask the questions really carefully, you'll be okay. Okay, let's go through. Earned income credit is a refundable tax credit for certain people who work. Why does it say that? You have to have earned income credit. Got to be earned. And it's got to be wages. Can't be a pension, can't be unemployment. It's got to be earned wages. As long as they have income less than $53,267, that would be somebody married, filing joint with 3 kids. A refundable credit often means money coming back to the taxpayer in the form of a refund. So somebody getting a good earned income credit, they're not going to have that high of a tax liability. They're going to be getting a refund that's coming back to them, and it's generally going to be a good amount of money. I just want to show you the way it works without having everything fall on me. This is, EIC is like a curve, okay? It's like a great big arch. Starting down here, like maybe $100, it goes up, 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 halfway, like $26,000. That would be the people that get the most earned income credit. Then it starts to go back down again. So the people that make the $53,000 are here. So you got 100 here, 53,000 over here. The arch goes up. They keep getting earned income credit the more they make. When they get up to that middle mark, then it starts coming back down again. Make sense? Okay. That is, so the more you make up to a certain point, there's the earned income credit is going to be highest. It pays for 1 child, for 2 children, or for 3 children. Or if you're between 25 and, well, we could go through the rules to see. But 25 and 65, no children, and you have a low income, you could get the EIC. But it has to be because you've earned wages. Okay, so rules for everyone. We're looking at the chart. Rules for everyone. Your adjusted gross income must be $47,747. If you have 3 kids, if you're married filing joint, then it would be $53,267. And then it goes down from there. For 2 kids, 1 child, and then the bottom, the $14,820. If you're a single person between 25 and 60, or $20,330 if you're married filing joint and you have no children, and you're between 25 and 65. Okay, you must have a valid Social Security number. Your filing status cannot be married filing separate. Here's another example where married filing separate, you lose the credit. You must be a U.S. citizen or resident alien all year. You cannot file a Form 2555 relating to foreign income. That would be you had a job and you had to go work in, say you had to go work in Paris for 4 months. The money you earn over there, you would file a 2555 to get that money back. So Your investment income cannot be more than $3,400. So even if you have a job and you're only making $20,000 a year and you would normally qualify for EIC, if you have a lot of money in the bank, which I think you'd have to have for $3,400 in interest, right? If you have unearned income interest from the bank, then you are not eligible for EIC. So if you're earning that kind of interest, they're not going to let you get the EIC. All right. Rules if you have a qualifying child. Your child must meet the relationship, age, residency, and joint return test. So it's got to be a blood child to you. So let's say you have a boyfriend, girlfriend living together. Let's say the girl has a child from a previous relationship. That's her child. Well, let's say she doesn't work. And he says, well, I'm going to claim the child as a dependent. Normally, could he do that? He can do that. He can claim that child as a dependent, but he cannot claim that child for earned income credit because of the relationship. It's not his blood child. Okay? So he can use the dependency, but he cannot claim that child for earned income credit because it is not his blood child. All right, your qualifying child cannot be used by more than one person to claim earned income credit. So in this case, let's say you have two parents, okay, they're divorced. Child lives with one, okay, let's just say, okay, mom and dad. The child lives with mom, but dad claims the child for dependency, and we know that we can do this, right? Mom is head of household with a child. Dad is single, claiming the child, right? Okay. Because the child lives with mom, mom can still claim the earned income credit even though she's not claiming the dependency for the child. Because the child is living in her home. She's supplying the house for that child. She can claim earned income credit even though dad gets to claim the child as a dependent. So mom is head of household, claiming her child lives with her 12 months, but on our codes, we're going to do a 0, non-dependent, right? We did that last week. But she can claim the earned income credit because she has that child in her house. Dad is single, right? Because he can't be head of household because the child doesn't live with him more than 6 months. Dad is single. He's claiming the child for dependency, but because he doesn't supply more than half of the household for that child, he cannot get earned income credit. So even though, in a way, they're both getting something for that child, only one of them can get EIC. Okay? So even though that kid's going to be on 2 different tax returns, only one of them can have earned income credit. So there can never be EIC twice for the same kid. All right. Rules, if you do not have a child, you must be at least 25, but under 65. So that means, like it said in that first block, you make under 15,000 and you don't have a child, you can get earned income credit. Why do you think they make the ages between 25 and 65? Why not 23? Why not 68?
Because usually about 65 people start collecting pensions.
Right. Because if they're under 25, generally, they're either going to be a student or they're just going to be starting out. And the chances of them making that lower amount are high. And the government says, well, we're not giving EIC to everybody. And the same thing at 65. That's when people are starting to retire and they're not making as much money. Again, the government says, you know, they're making lower income because they're retiring. We're not giving them all the extra money. So that's how they cap it. 25 to 65, you're eligible. Where you're generally going to be making less, they say no, thank you. Okay.
Now, if a person is single,
Mm-hmm.
they have a child, but that child lives with the mother,
Mhm.
can he claim EIC for himself if he's entered the
15,000?
15,000 government?
Yep.
But he just can't do it for the child.
He just
But can
can't.
do it for him.
Right.
Even though the child can be claimed on his
Correct.
taxes.
He would, yeah. That, because EIC would be for him, not the child.
You see a lot of those.
Yeah. All right, so figuring and claiming the EIC. Your earned income must be less than, and it goes through the charts again. Okay? All right, rules for EIC, pretty much on page 5. That's pretty much the same thing we just talked about in the chart. All right, non-taxable combat pay election. Remember we talked when we were talking about W-2s, and we talked about people that are deployed. They're in the military and they're deployed, that not all of their income is taxable. When they are deployed, they are getting combat pay, and we said they're not paying tax on that money, right? Okay, well, the IRS says, but they want to do something to help them. That money that they don't pay tax on, they can use, considered as income for EIC. So they can, let's say they make $30,000 a year, all right? But they're deployed, and only 5,000 of it is going to be taxed this year because the majority of it, they were overseas. The IRS says, you know what? We're going to let you use that whole 30,000 towards EIC. So even though they're not paying tax on it, if it's combat pay, then they can use that full income, which is a really good thing. Remember what? Oh, it says right here. It's a code Q. Box 12, it'll say a code Q, and that's your key that it is considered combat pay, that they were more likely deployed for a part of the year, and that's why their income is going to be not all taxed. But we can use it once we put that Q in there. It's going to let us use it for EIC. So if they have a qualifying child at home, they can get the earned income credit on the full amount that they earned that year, even though part of it was combat pay that they're not paying tax on. All right, EIC examples. John and Janet Smith, a married couple with one qualifying child. John and Janet Smith are married and will file a joint return. They have one child, Amy, who is 3. Amy lives with John and Janet for all of 15. John worked and earned $9,500. Janet worked part of the year and earned $1,500. Their earned income was $11,000. John and Janet qualify for EIC and will fill out the EIC worksheet, which we will go over on the computer. Okay. So you'll see they made $11,000 between the two of them, right? Okay, after they take off their standard deduction and their personal exemption, none of their money is going to be taxable. But they're still going to get EIC based on that $11,000 because it was earned income. So they're going to get an EIC credit of $3,359. So that's roughly what? A little more than a third of what they earned all year. They're going to get a credit back to them. Okay. On page 9, Kelly Green is 30 and a full-time student. She lived with her parents in the United States for all of 15. She had a part-time job and earned $62.40. She earned $20 in interest on a savings account. She's not eligible to be claimed on her parents' return as a dependent. Although she lived with her parents, she is not their qualifying child because she doesn't meet the age test. Kelly qualifies for earned income credit because she made less than that, what is it, almost 15,000, okay? So she made $62.40, and after her standard deduction and her personal exemption, again, she'll have no taxable income. Her earned income credit is $476. Big different than the other one, isn't it? Mm-hmm. See what the difference a kid makes? You have a child and had a household, that number jumps drastically. Okay, then there's going to be a series of questions on the computer that you have to ask the taxpayer. Did that child live with you all 12 months? And you have to ask these things, even though it's the same questions and you know they're going to tell you the same answers, you still have to ask it, okay? Because we have to make sure that we are asking the questions, because we're going to ask them to sign off on these questions, that everything they told us was true and accurate. So we've got to make sure that we really do ask the questions. And you'll see on 11 that there really are penalties for the fraud. So if somebody comes in and says, you take their W-2 and they have $10,000 in income, and they've got a family of 4, and you ask them, do you have any other income? Nope, that's it. And then they say, oh, here's my mortgage statement, and you see that they're got mortgage interest of $6,000, property taxes of $5,000. It's not going to add up, right? It's going to, first thing that's going to go off in your head is, and I would ask, is there any other income? Nope, there's no other income. What's your first thought going to be? They're not telling you the truth. So don't just take it for what's in front of you. Ask the questions. Because if something is really fraud, first of all, what they're doing is wrong. But by putting your name on something that really doesn't make any sense, the IRS does look at stuff. So you don't want to, it's basically a lot of common sense. Just look at it, you know, see if it adds up. You know, people come in all the time, and if you never know, I always ask the question, who pays the mortgage? Or how do you pay the mortgage? Oh, well, I have family members that help us. Okay. Or we're living on a credit card right now. We're in between jobs. We had a bad year. We're living on our credit card now. So you have to ask the questions. I know, because then it makes you wonder, but you have to ask the questions. If it doesn't add up, make sure you're checking and to see why. Okay, due diligence promotes accurate EIC claims. Incorrect tax returns and failure to comply with the due diligence requirement can adversely affect you, the tax preparer, and your client. The IRS can examine your client's return, and if it's found to be incorrect, can assess your client accuracy or fraud penalties. If they can prove that this person committed fraud, they will go after it, and then they'll check with you. We have documents that they have to sign stating that everything they told us is true and accurate. But you really have to, you know, just think it all through. Some people will have really a low income, and it is all true, you know? But you got to really look at it carefully, case by case. Okay, if you fail to comply with EIC due diligence, the IRS can assess a $500 penalty against you and your employer for each failure. And if they see something that they don't like, they won't just stop at that one return. They'll say, I want to see everything that person did this year, you know, because they're going to look for something. But as long as you're covering yourself and you're asking all the questions, then you're going to be okay. It's just a matter of really paying attention and asking the questions. If you prepare a client's return and any part of the understatement of the tax liability is due to an unreasonable position, the IRS can assess a minimum penalty of $1,000 against you. If they really feel and they prove that you did something illegal, they can press charges. They'll fine you $5,000. They won't stop, just probably to make a statement. But it's really important that you just ask the questions. You can be subject to disciplinary action. You can be barred from preparing tax returns. You can be subject to criminal prosecution. All right, pay particular attention to the following 3 issues that count for more than 60% of all EIC errors. claiming a child that does not meet age, relationship, or residency. Oh, that would be like dad trying to claim EIC when he gets the dependency, but he can't claim EIC if the child doesn't live with him. Another thing is if a couple is legally married and they file single or both head of household using different addresses with kids. There's not everything that you're going to see because you can't, you know. But another thing with EIC, now they want proof. Everybody who files a tax return and has EIC for a child has to produce some sort of proof. And the proof that they're looking for is either medical bills, school records, a report card, anything with the child's name and address. The child's name and address has to be on the bill. And it has to match your name and address. And it's got to be your current address. So they are checking. They want proof, and that's what they're looking for. They're looking for proof that that child actually lives in your house. So if they see you put a child on your tax return and you have no way to verify it, is the IRS going to believe it? No. No. So we do have to see that, as that's an IRS rule now. And there's a part of the tax return where you have to check the box to see what sort of proof you have seen. So they want to know, and they give you a list of things to look at. Some of the times, I've noticed a lot of the newer birth certificates will have mom's name and address, dad's name and address, and the child's name, and I've seen some of the newer ones with the address on there. And if that is where you're still living, and that's the baby's address, then there's a source. A daycare bill, if the daycare has the child's, not your name and address with the kid's name over on the side, but if the child's name and address is on it, that could be something. The healthcare form, now that everybody's got to have healthcare forms. They can't say, well, I have my benefits card here. It's got the child's name on it, but there's no address. What they're doing is verifying that the child does indeed live with you. So they are trying to cover the gaps. They're also giving you the option to cover yourself too. So that's not a bad thing.
Good. Question.
Yes.
Say if they got divorced, the mother went back using her maiden name.
Yep.
But the children still have father's name.
Right.
So like school records would have to show the kid's married name?
No, the kid's name is always going to be their name.
Okay.
All they care about is that it matches the address.
Oh, okay. That's good. That
The
doesn't
dress.
have to match.
Oh, no, their name's, once that child's name's
Yeah.
going to stay the same.
Right.
But they want to match the address. They want to make sure that that child lives with you at that address. Okay? If somebody comes in and says, well, I don't have that with me, we do as much of the return as you can, and we can put it on hold, and they can bring it back because we have to see the proof. And, I mean, they can see right on the screen. It's not us that's questioning. It's the IRS. This is a new IRS guideline, and we just have to follow it because that's their rules. Okay. As a paid preparer who prepares tax returns claiming the EIC, you must meet 4 due diligence requirements. They focus on accurately determining a taxpayer's eligibility for the EIC and computing the credit. All right, so know the EIC tax laws, evaluate your client's information, ask the right questions, and document the questions that you're asking. And you'll see on our computer that those are right in there. They're part of the tax return. Okay, let's see. You have somebody come in, and they say, let's say they're 22 years old. I'm claiming my brother and sister. And this is one of the questions. Why are your parents not claiming them? Oh, they don't file anymore. Who lives in the house? And they may say, oh, mom and dad, we all live together. But I'm the only one working right now. They're on Social Security, so I'm going to claim them. They can't do that. You can't just decide who you're going to put on there to get earned income credit. If they were put in your house, or if they were put in your care and you are a guardian, then absolutely, you could take your brother and sister. You ask the questions. You know, somebody could come in and say, I have my niece living with you. Why are the parents not claiming her? She was having trouble. I was granted guardianship. She's living with me, and I've got her back in school, and she's doing wonderful. Absolutely, that aunt can get EIC for her. She has guardianship. That child's living with her, and you've asked the questions, and that's a good thing. Okay. Complete Form 8867, the Paid Preparers Earned Income Credit Checklist. You'll see it's on page 13. These are the questions we have to ask, and it's in the computer. Okay, well, part of it will fill automatically. If it's married filing separate, it'll kick it right up because it won't even let you file for EIC. Does the taxpayer have a Social Security number? Well, that's going to fill in automatically because once we put it in, the computer will see that that Social Security number is there. Was the taxpayer a non-resident alien? You have to ask them, are you a U.S. citizen? If they say no, you check that box and they are not eligible. The computer will make the determination. All you have to do is answer the questions. Again, is the taxpayer married filing joint? Yes or no. Is their investment income $3,400? Once you have the tax return finished, that's going to populate right in there because of what schedule? Schedule B, right. This one you'll have to answer. Could the taxpayer, meaning the parent, be a qualifying child of another person? Yes or no? No. If it's no, then you check that and you're good to go.
This is what covers us.
Right. It also will determine partly if they qualify for the earned income credit. Okay? And this next bunch of questions will be on there as well. Is the child the son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, and it'll go on. That will fill in automatically because you've already filled it in on the main information page. All right, you'll see where a lot of these things will carry right over for you. Number 10. Most people answer this question wrong until we drill it into their heads. Was the child unmarried at the end of 2015? And the answer is yes. Everybody looks at and says, is the child married? Because they word it ridiculous, and it says, is the child unmarried? So you have to say yes. Okay? Everybody's going to get that wrong when you're doing the practice problems, and you're going to say, I didn't get the EIC to come out. And that's going to be why. I guarantee you every one of you will do it. Okay. Did the child live with the taxpayer in the United States for over half of 2015? Even though you've asked them this before, you're going to ask it again. And the child lived with you for more than 6 months of the year? And they'll say yes, and then you can check the box. Trying to think what else. The age things will populate over. Oh, number 13. Do you or the taxpayer know of another person who could check yes to 9, 10, 11, and 12 for the child? Is there anybody else that could claim earned income credit for this child? They say no. Anybody else that tries is going to get a letter from the IRS saying, hey, somebody else already claimed earned income credit for this child. Show us some proof that you can actually do this. And they will. Okay. Does the qualifying child have a social security that allows him or her to work and is valid for EIC purposes? You'll have to answer that one. Even though they have a social security number, the IRS wants you to look at it. I mean, not look at the card itself, but they want you to say, yes, this child can work in the United States. That's going to be a yes. You hope. Okay. Does anybody have any questions so far? The biggest thing we have to really concern ourselves with is this person an eligible child to be in this house for earned income credit? Okay, let's say you have someone that comes in, they're 45 years old. They have their sister living with them because she's disabled, and let's say she's 40. And the taxpayer that's in front of you made $20,000. So she's going to file head of household. She's got her sister that she is her dependent. Does she qualify for EIC? Nope, because she's not under 24 years old. She's got to be a qualifying child. Once they hit 24, they're not getting it. Okay? Unless they're totally and permanently disabled for a child. I don't think they could get it for sister. It's a good question. I'll have to look that one up. But if the age, the relationship, all has to be put in play. Make sure you're asking the questions. That's the biggest thing. If somebody comes in and they're claiming 3 kids, they're a single person, they're claiming 3 kids, and you looked at last year's tax return and they didn't have any. You know, you have to really question, who are these children? Oh, they're mine, but I didn't claim them last year. Why didn't you claim them last year? And you really have to ask questions, because you don't want to accuse anyone of anything, but you just have to be aware. When you look at the amounts of money that people get for earned income credit, it's huge. It's huge. If somebody's got 3 kids, between the federal earned income credit and the state earned income credit, that could be an additional $10,000 that they're walking out with. Could that be an incentive for somebody to cheat the system? Absolutely. So we don't want our name on what they're trying to do. So you just have to really look, just pay attention, you know. Somebody comes in and they say, well, this is my child, and the kid is 4 years younger than them. Obviously, you just have to really, really pay attention to the little stuff. This more than anything else, because you don't want, and if somebody is self-employed, they may come in and say, I cleaned houses. I made $20,000 last year. So what are they looking at? They're looking at, they're going to get $6,000 earned income credit. What should be your first question? Did you have any expenses? If they say no, I don't know of anybody who has a business that doesn't have any expenses, especially if you clean houses. You've got mileage, you're driving from house to house. Do you buy cleaning supplies? You have to have expenses. If they have expenses, they have to claim it. They have to claim all their income. We've had people come in and say, well, I made $20,000. And then we put their expenses in, and it brings their income down to $10,000. And they say, oh, you know what? Put $8,000 more on my income. So anybody who is self-employed, I shouldn't say could be guaranteed, but if that's all the income they have is self-employment, and they're collecting earned income credit, there's a very good chance that before the IRS will release their refund, they're going to send them a letter and ask for proof. They're going to say, we want to see receipts from income you earned, and we want to see receipts for your expenses. And that makes sense, right? Because how else can the IRS track it? So if somebody is self-employed and they're getting earned income credit, it's a very good chance that they would be questioned by the IRS for their receipts, for their income. They may look for bank statements to see where the deposits are. They might say, do you have a separate bank account for your business? Who knows what they'll ask for, but they're going to want to see some sort of proof. Now, let's say you have a married couple, or let's say a divorced couple, not a married couple because they wouldn't do that. A divorced couple, and maybe they alternate every other year. One person claims a child one year, one person claims a child the next year. Now we know that only the one where the child lives gets the EIC. So what happens if you have a divorced couple that don't really communicate very well? They always want to really do one better than the other person. So they run in and they file their taxes really quick and they claim the child when it's not their year. Or let's say the child doesn't live with them, they have no rights to claim them according to a divorce decree, but they run in to claim that child to get EIC. And then the person where the child actually lives files their return, it's rejected by the IRS. So what we have to do then is mail in a paper tax return. So the person who really should be claiming the child and getting the EIC is going to wait 6 months to get their refund. Truthfully, some people do that just so the spouse has to wait 6 months to get their refund. Who's the child? But what they'll do, the IRS will say, okay, I want to see proof from you, and I want to see proof from you. And then they're going to look at the proof, and if somebody claimed the child that shouldn't have, they're going to have to pay that money back, where the correct one will get the refund. But that will take them about 6 months. So if somebody says, I'm not really sure if it's my year, let them know. If it's not, this is what could happen. You're going to wait a long time for your refund. It's really a good idea if you can communicate with an ex-spouse that you check to make sure who's claiming the child. The IRS has already come out and said that in 2017, they're going to hold refunds a little bit. And that's one of the reasons why. Because if you've got two people claiming the same child, they're going to verify who should have that child before they release any refund. So they don't have to try getting the money back from somebody, which does make sense. So anybody who is filing with EIC, according to the IRS, they're going to have to wait a little longer next year to get their refund back because they are going to verify. Anybody have any questions on EIC? Big, big, big is that we ask the questions, okay? I'm going to pull it up on the computer. Oops, I guess I should turn it on. And I apologize if you can't see this. During the day class, I can turn the lights off and you can still see. I can't, there's no other lights. I can't just shut half of these off. Okay, so we're going to say that Sue Smith is head of household and she has Billy Smith, and that's her son. He lived with her all 12 months, and that is her child who lives with her, okay? And we always check the EIC box. All right, now let's give her some income. We'll say she makes $25,000. Okay, so just putting the 25,000 in, let's see the 1040. Her earnings were 25,000. Her standard deduction for being head of household is $9,250. Her personal exemption is $8,000 because that's $4,000 for her, $4,000 for Billy. So her tax liability is $778. Her child tax credit, which we'll talk about later, comes off. She has zero tax liability. So she's paying zero tax on her money. But because of earned income credit, they are, well, she had the additional child tax credit in there. But they are going to send her $2,254 for EIC. Let me change this so I don't have to deal with that other thing in there. Okay. All right. I gave her a raise. Oh, no, I didn't. I took money away from her. $15,000. Okay? She's making $15,000. She is going to get a $1,000 child tax credit, which we'll talk about later, but $3,359 for earned income credit. Okay? That's for her and her child living with her. Now, let's say that Susie Smith has Billy Smith living with her, but Dad could claim Billy. Okay? So we all know that we're going to put 12 months. Billy lives in her house for 12 months, even though Dad's claiming him. And over here, we're going to say non-dependent. A 0, non-dependent. He lives there 12 months, but he's not her dependent. He's Dad's dependent this year. Okay? Everybody with me?
Yes.
Okay. So, $3,359. It's the same number, isn't it? Just because he lives there. So she's still going to get that EIC because he lives in her house. Now let's flip it over and do Dad. Jim Smith. Okay? Now, he's not head of household. He's going to be single, right? Because Billy lives with Mom. So he's single. He lives with Mom. So he's actually with Jim 0 months. And he is a code 2, your child who does not live with you. Because he's claiming independency for Billy, but Billy does not live with him. So we're going to do a number 2. All right, a code 2. We're still going to, I always check the EIC box, but let's look over here. It says earned income credit, no. It's checked, no, automatically checks no, because he doesn't live there. He doesn't qualify. So as long as you fill in the main information page right, and you watch the boxes, you watch the months and home, and the filing status, the computer's going to know exactly what to do. Okay? Let me see, what else could we do? let's make it a head of household. Okay, so I just gave, let me see, who are we on now? Let's make this Sue again. Okay, so now let's say Sue's got 3 kids. Sue makes $15,000. And after her standard deduction of $9,250 for being head of household, $16,000 for personal exemptions, that's $4,000 for each child, and there's her and the 3 kids, that's 4 people, $16,000. $5,548 for her earned income credit. Okay? She's going to get $1,800 for additional child tax credit, which again we'll talk about in a little bit. But look at her refund. She makes $15,000. $73.48 is her refund. And then we jump over to New York State. New York State will give her a percentage of that. So she's going to get $1,627 from New York. Okay? Now, let's see. All right, Dad's claiming all the kids. Whoops. Oh, whoops. I missed that bottom one. On Sarah, that should have been 12 months. Yeah, that changed the whole thing here. I made a mistake when I put that in before. I only hit 2 months for Sarah instead of 12. So instead of that $1,800 for additional child tax credit, did it again. Okay. She's still only going to get $1,800 for the additional child tax credit, but I had put 2 months in there instead of 12, so she wasn't getting EIC for that 3rd child. $62.42 is her earned income credit for the federal, and from New York, $18.36. Okay, so let's go back and let Dad claim all the kids. They're all still 12 months in her home, but now they're her non-dependents because Dad is claiming all of them. Okay. She's not going to get the additional child tax credit, but she's going to get $62.42 for earned income credit for those 3 kids that are living with her, even though Dad's claiming them. She can still get that EIC. All right, now let's put all 3 kids back with Dad. They live 0 months in his house. And they are all a code 2, which is your child that does not live with you. And can he be head of household? No, he's single because they live with Mom. She is the custodial parent. All right, so he's getting that $1,800 additional child tax credit, which we'll talk about, but he gets 0 earned income credit because the kids live with Mom, not him. Only one person gets that EIC. Okay, now let's say Jim Smith makes 10,000. And is single. And he has 0 children. Okay, he makes 10,000, he has 0 children. He's going to get $367 for EIC. So this is where, even if you have no children, if you have low income, below their guidelines, you will get the EIC. I'm going to put one kid back on and show you the questions. Okay, so I'm back to Sue, okay? Sue makes $15,000 and she's just got the one child. I've just got her back here with Sarah. She's head of household and she has Sarah and she's claiming EIC. So look what's going to come up over here on the side. It's going to come up EIC worksheet. And here are the questions that we're going to start answering. Does the taxpayer have a social security number that allows him or her to work or is valid for EIC purposes? Yes. The only ones that would not be U.S. citizens, okay? Was the taxpayer a non-resident alien? No. U.S. citizen. Could the taxpayer, meaning Sue Smith, be the qualifying child of another person? Nope. She lives by herself with Sarah. And then this is where we say, enter is either of the following true? Is the child unmarried? Yes. That's the one that you're going to get wrong at least once, because you're going to think it says married. Remember that first question is yes, the child is unmarried. Did the child live with the taxpayer in the United States for over half of the year? And you say, did Sarah live with you for more than half of the year? Yes. Do you or the taxpayer know of any other person who can claim the child for EIC? When it says, do you or the taxpayer, that means you, the preparer. Do you or the taxpayer know of any other person that can claim the child for EIC? And then you ask them, can anyone else claim this child for EIC? Nope. Does the qualifying child have a social security number that allows him or her to work? Didn't they already ask us this once? Yep. There are questions that they're going to ask you, sometimes the same question in 2 different ways. Do you think they're trying to verify information? Yep. If you had EIC on your 2014 income tax return, was the EIC reduced or disallowed? And the way to ask this, have you ever been disallowed earned income credit on a tax return? They'll say, what? If that's their answer, then they haven't, because they would know. Okay, so no. Oh, look, isn't the wonderful thing? We have a blue check mark. Okay, then here's another, 8867, 4 pages of them. This will all fill in automatically for you. Let me do that right now. Okay, I just took 2 pages of them off by filling in my information. Okay, this is just, these automatically will populate over for you. So you're going to go to the questions where the red exclamation is. Did you complete this form, this 8867, that's this form. And they're asking you, the preparer, did you complete form 8867 based on the information provided by the taxpayer or reasonably obtained by you? Yes, because they're sitting right in front of you. You're asking them the questions. So yes. If the qualifying child was not the taxpayer's son or daughter, did you ask why the parents were not claiming the child? Okay, now if this is Sarah is Sue's daughter, obviously it's a son or daughter, right? And I can say that does not apply because it's her child. If it wasn't her child, I can say, yes, I asked, why aren't the parents not claiming this child? Did you ask the taxpayer any additional questions that are necessary to meet your knowledge requirements? Did you ask them any additional questions? Did you ask them, do you have any other income? Does this child live with you all 12 months? You've asked these questions, so you can say yes. Did you document the taxpayer's answers? I say does not apply here because by answering all the questions on these forms, those are the answers. Number 26, and this is the biggie. This is the biggie. Identify below any documents that the taxpayer provided to you and that you relied on to determine the taxpayer's EIC eligibility. Check all that apply. Keep a copy of the documents you relied on. They want us to keep a copy, okay? We can scan them into our computer. You'll see all that, not here in practice, but photocopies. Some people will bring in extra copies because they know they have to do this. They'll bring an extra copy and they'll say, this isn't, I made this copy for you to keep. That's what we need. We need the proof. And they want a school record, which could be something from the school, a report card. Landlord or property management. This could be a copy of a lease with the parent's name on it and the child's name on the lease. So a lease, that's going to show an address. That's going to show the child lives there. Healthcare provider statement. That could be a letter from the doctor. That could be a medical bill, something like that. Medical records, that could be a medical bill. Child care provider records, that could be something from the daycare. Placement agency statement. If somebody's a guardian, this could be a copy of the guardianship papers granted by the court. It's going to have an address. Social service records. Place of worship statement. Indian tribal official statement. Employer statement. An employer statement is the child working. Maybe you have a 16-year-old kid and you have their W-2 because you're going to do their taxes next. You're going to have your W-2 there. That's going to have their name and address. So that's a valid source of proof as well. Other, if there's something different, you can put other and put what it is. Okay? Something has to be checked. It can't be left unchecked. First of all, it will not transmit to the IRS, but we have to have documents. Okay? Any questions?
Are you gonna verify the date of the document? Like, if it's school records, like you want it to be.
It would have to be something somewhat current, right? Right.
But like the placement agency or social service records, that could be.
Well, the thing is, it's got to match mom and dad's address. So if the child is in that address, oh, I just had it here.
All right, now I'm done, right?
You're done. Thanks. It's going to match mom and dad's address. So it's going to be, it should be somewhat current. You don't want anything that's dated 10 years ago. But, I mean, you have no control if it's guardianship. I would think probably, it would still be good as long as it's got that same address. But, yes.
So the red explanation of March, those are forms that we filled
Those are the forms that need to be filled out.
And when you're done, it's a blue check mark.
When you're finished, it does a blue check mark, correct. All right, so let's say I had a report card. I'm gonna check. And now I have blue check marks, and I have verified with everything the IRS wants, I have verified that that earned income credit is a good credit, okay? I've asked all the questions. They have answered to the best of my knowledge they're correct. Yes.
Then that one question about can this child be claimed for earned income credit on anybody else? Would that be like if adult parent like lives with grandparents,
Right.
but like the grandparents, don't file because they don't make enough income? Is that when that question would be no? Or
No,
yes?
because they wouldn't qualify for EIC. The parents wouldn't qualify for EIC. The grandparents would not qualify for EIC,
Well, would
especially
they
if they
still
didn't
be
have
in-
income, because they have no earned income. So even if they were collecting Social Security, that's not earned income. So they wouldn't qualify for EIC anyway.
So you'd be answering no to that question.
Correct, because nobody else can claim that child for EIC.
But they can be claimed as if you can, but not EIC. If we're living
The
together,
only time they can be claimed as a dependent and no EIC is if they're not living with them. Like dad claiming the child when the child lives with mom. Okay? If it were to the point where the grandparents or whoever and them saying they're claiming their siblings because mom and dad don't make enough money, they're not going to claim them as dependents anyway. Okay? So they're not going to be on there because that person's definitely not going to be head of household. Okay?
I was just trying to figure out
I
in
know.
what situation would you get a yes to that question?
My guess would be,
Well, if you get a yes, then
right.
only
If
one
you have
person
two
can get it.
parents, say you have two parents that live together right in front of you. One of them can be head of household. One of them is single, right? Even if they have two kids. One's head of household, one is single. Only one of those parents can claim EIC. But what if they make almost exactly the same thing? Then you could say, yes, somebody else could claim the child for EIC, but they're not. See what I mean? So somebody else possibly could, doesn't mean they are. Two people could be in a position where, yes, if I claim the child, I can be head of household with EIC. But they're not doing it because the other parent is going to be filing head of household with EIC. Okay, any questions on that? All right, let's see here. All right. On 16, an employer may be penalized for an employee's failure to exercise due diligence if any one of the following apply. The employer or a principal member of management participated in or prior to the time the return was filed knew of the failure to comply with due diligence. So if we knew that one of our preparers was committing fraud, who's liable? We are. Right. Because you know something's going on, that person cannot file a tax return or work for you. The firm disregarded its reasonable and appropriate compliance procedures through willfulness, recklessness, or gross indifference in the preparation of the tax return. As you can see by our software, we promote due diligence because we make sure everybody's asking the questions by making them fill it in the software. Okay, Let's read the examples on 17. A client wants to use his niece or nephew to claim EIC. You should ask enough questions to determine whether the children meet EIC qualifying child requirements for your client. You should also ask enough questions to ensure the child's parents or other relatives will not or cannot claim the child. That's how we talked about, you know, maybe they have guardianship, okay? An 18-year-old client with an infant has $3,000 in earned income and states she lives with her parents. She wants to claim the infant as a qualifying child for EIC. This information seems incomplete and inconsistent because the 18-year-old lives with her parents and earns very little income. You must ask additional questions. What would your question be? Are your parents claiming you? If she's 18, her parents are probably still claiming her as a dependent if she only makes $3,000. So you would need to ask more questions. A 22-year-old client wants to claim his two sons, aged 10 and 11, as qualifying children for EIC. You must make additional reasonable inquiries regarding the relationship between your client and the children since the age seems to be inconsistent. Again, common sense. Something doesn't look right, ask the question. Can you believe anybody would even come in with a straight face to try to do that? A client has two qualifying children and wants to claim EIC. She tells you she had a Schedule C, which is business income, and earned $10,000 in income and has no expenses. This information appears to be incomplete because it's unusual that someone who is self-employed has no business expenses. Well, we talked about this. You must ask additional reasonable questions to determine if the business, first of all, actually exists and if the information about her income and expenses are correct. If the IRS examines and denies all or part of the EIC, the client must pay back the amount with interest, may need to file an 8862 information to claim earned income credit after disallowance, which means they're going to disallow it, and in future years they're going to have to, if they want to try to get it again, they're going to have to file a separate form because they've been disallowed. They may be banned from claiming EIC for the next 2 years if the IRS finds the error because of reckless or intentional disregard of the rules. Or they may be banned from claiming EIC for the next 10 years if they find the error is because of fraud. That would probably be if they had a Social Security card of a child that wasn't theirs and that did not live with them. That would be considered fraud, and they could lose the EIC for 10 years. And they could also be, they could go after them in some sort of legal way as well, I think, for fraud. But, okay. 19. Did you guys look at the EIC charts? Okay, earned income of $29,500 for someone married filing joint with two children. What would their, with two children, what would their EIC be?
4307.
4307. Somebody earning $49.51 who's head of household with one child. 1692, right. Someone who is single, earned income of $28,855 with two children. 3281. And these all came from the Pub 17 earned income credit tax tables. That's where these came from, right? All you have to do is look at the chart, put in the income, and it tells you how much the EIC is. All right, $23,608, married filing separate with two kids. Zero, right, they cannot have it. Married filing separate, they say no. $13,694 for head of household with two kids. 5470, right. 10,200, single with 0 kids. 352, very good. Okay. On page 20. Which of the following taxpayers qualify to claim EIC? Write yes or no on the appropriate line. If the answer is no, explain why. James and Mary live together all year. They have 2 children, ages 5 and 8. They use the married filing separate status. The couple's income is within the earned income credit level. James would like to claim his children for the EIC. Is he able to do so?
No.
No, because married filing separate, correct. Can Mary?
No.
No, she's married filing separate too. Okay, Wanda Jones provided a home for her daughter who is 17 all year. She uses the head of household filing status. Her AGI is $39,000. Can she claim the credit?
Yes.
Yep. Larry and Sandy Smith filed jointly on their return. Their dependent grandson lived with them all year. Their only income was from pension, interest, and Social Security. Their income amounted to $19,000. Can they claim the credit? Why? No earned income, correct. Maria Sampson, who is 67, is single and self-supporting. Her earned income is $9,100. Is Maria able to claim the credit? Nope.
Cool.
Isn't that sad that somebody 67 is too old? All right, Jack Demick, who's 26, uses the single filing status. His earned income and AGI were both 10.5. Can he claim the credit?
Yes.
Yes, he can. Sandy, who is 4, is the daughter of Jim Jones and Shirley, who's 28, who lived together all year. The couple is not married. Jim's AGI is 24, and Shirley's is 15. Shirley and Jim cannot agree on who should take the child. They want the IRS to decide. Is Shirley allowed to take the credit?
No.
No. Why?
Because the tiebreaker.
Tiebreaker. If there's a tiebreaker with the parents, the IRS is going to decide they're going to take the parent that has the higher AGI. All right. Jim and Fran were divorced in May of 15. They have one son, Jared. Jim was granted a divorce decree stating that he can use Jared as an exemption on his tax return. Jared has lived with his mother since May. Jim's AGI was 24 and Fran's was 12. Jim would like to use Jared for EIC. Is he able to take the credit?
No.
Nope. Why?
Residency.
He lives with mom. Okay, using the question above, can Fran claim Jared for EIC?
Yes.
Yep. Even though dad is claiming the dependency, he lives with mom, mom can get the earned income credit. Okay. Now on 21 is additional child tax credit. Let's take a break. Give you a 10-minute break, and then we'll come back and we'll work on the additional child tax credit. Does anybody have any questions at all on EIC? Yes.
What is the reason behind not being able to get EIC if you're married filing separate?
Married filing separate, they just feel people are going to use the system. That's why you can't claim almost any of the credits.
It's like fraud deterrent.
Yeah. And because people could filing, if they both filed separate returns, they could possibly get a higher refund using the credits to their favor, and the IRS says no. So married filing separate, child tax credit is the only one you're going to get. Okay? Then we'll talk about that when we get into child tax credit. But yeah, married filing separate, child tax credit's the only one you're going to get. All right, let's take a little bit of a break.